Disclaimer.
Hey G here, and I love a good market mystery, especially when it's hiding in plain sight. $71 for silver on your screen, $85 in your hands, and Wall Street insists everything's fine. Let me show you what 60% of New York's silver vaults vanishing in 4 days really means. This price gap is not a glitch. It's evidence that one of our most critical commodity markets is quietly breaking apart, and the people who understand what's happening are racing to get physical metal before the system admits the truth. Here's the empowering part. You still have time to position yourself on the right side of this before the door closes. Between December 20th and December 24th, 2025, traders demanded delivery of 47.6 million ounces of physical silver from the Comex exchange in New York. That's not a normal week. That's not even a normal year. In just 4 days, market participants drained 60% of the silver sitting in registered vaults available for delivery. And here's the part that should grab your attention. The paper price barely moved. Think about what that means for a moment. Imagine walking into a store where a flat-screen TV is priced at $71, but when you try to actually buy one, the salesman tells you they're back-ordered for 8 weeks, and you'll need to pay $85 instead. You'd know something was deeply wrong with that store's inventory system, wouldn't you? That's exactly what's happening right now in our silver markets, except we're not talking about televisions. We're talking about a critical industrial metal that goes into solar panels, electric vehicles, semiconductors, and defense systems. According to Comex's own delivery data, released in early January 2026, those 47.6 million ounces represented the single largest 4-day delivery demand in the exchange's modern history. Yet, on December 24th, 2025, when the dust settled on that vault raid, silver closed at just $71 per ounce on paper contracts. Meanwhile, if you tried to actually buy physical silver that same day from dealers across America, you'd be quoted prices between $80 and $95 per ounce, assuming they had any inventory at all. Major bullion dealers from Texas to Pennsylvania started posting $8 to $12 premiums over the official Comex spot price, with delivery windows stretching 6 to 8 weeks into the future. Here's where it gets interesting. The Comex exchange operates on a simple principle that has worked for decades. Most traders don't actually want the physical metal. They're speculating on price movements, happy to settle their contracts in cash when expiration comes. Maybe 2 or 3% historically demand actual delivery. Exchange officials have built their entire system around that assumption, keeping just enough physical inventory in registered vaults to satisfy the small minority who want real bars instead of paper profits. But what happens when that assumption breaks down? What happens when 10, 20, or 30% of contract holders suddenly demand the actual metal? We're finding out right now, and the answer is starting to look like a slow-motion bank run in precious metals. Now let me put this in perspective for you. At the start of 2020, Comex registered vaults held 346 million ounces of silver available for delivery. These are the real bars sitting in warehouses in New York and Delaware, certified and ready to be handed over to anyone with a contract demanding physical settlement. By December 2025, that number had collapsed to just under 100 million ounces. That's a 73% decline in available inventory over 5 years, according to data published by the CME Group, which operates Comex. Now here's the mathematical problem that nobody on Wall Street wants to discuss openly. While our registered silver inventory fell by nearly 3/4, global industrial demand for physical silver exploded in the opposite direction. The solar panel industry alone now consumes over 200 million ounces of silver annually, according to the Silver Institute's 2025 World Silver Survey. That's up 300% from 2020 levels. Electric vehicles use 3 times more silver per unit than traditional cars. 5G infrastructure build-out requires massive quantities of silver for all those new cell towers and switching stations. Add in aerospace and medical devices and the semiconductor boom, and you've got industrial demand that's grown roughly 40% since 2020. So let's do the simple math together. Less physical silver sitting in vaults available for delivery. Dramatically more industrial users who genuinely need that physical metal for manufacturing, and a paper market that continues operating as if nothing has changed, with investment banks selling silver contracts as freely as ever at prices that have barely budged. What could possibly go wrong? You don't need a PhD in economics to see the disconnect here. When physical dealers in Houston and Phoenix are charging $85 per ounce with 8-week wait times, while Comex claims you can settle a contract for $71 with immediate delivery, one of these markets is lying. Either Comex is suppressing the true price of immediately available physical silver, or retail dealers across America have somehow coordinated the world's most effective price-fixing scheme. I'll let you decide which scenario makes more sense. The exchange's response to these delivery demands has been predictable and revealing. Comex officials released statements in late December assuring markets that adequate supplies of silver remain available to meet all delivery obligations. They pointed to eligible silver, bars sitting in Comex warehouses that are certified but not necessarily designated for immediate delivery, as evidence that no shortage exists. Technically true, but deeply misleading. Eligible silver can only be delivered if the owner of those bars decides to convert them to registered status. It's silver that's in the vault, but not actually for sale. Think of it this way. Your neighbor has 100 pounds of sugar stored in their garage, but that doesn't mean you can bake a cake with it. It's eligible sugar, you might say, technically available in your neighborhood. But unless your neighbor agrees to sell it to you, that sugar isn't solving your baking emergency. Comex is counting sugar in other people's garages and calling it a solution to the shortage. According to interviews with bullion dealers published in industry trade publications throughout late 2025, something fundamental shifted in the physical silver market during the fourth quarter. Dealers who'd operated for decades on the assumption that they could always source inventory from wholesalers suddenly found themselves competing for limited supplies. Phone calls to Swiss refiners that used to result in shipments arriving within 2 weeks started ending with delivery windows of 2 or 3 months. Premium quotes that had historically stayed within $1 or $2 of Comex spot prices ballooned to $8, $10, or $12 spreads by year's end. One major Texas dealer, interviewed by Kiko News in December 2025, described the situation in stark terms. We're seeing demand levels that typically follow a major currency crisis or war, but we're not in either of those scenarios yet. The premium structure tells us physical metal is far scarcer than the paper price suggests. Something's breaking down between what Comex claims is available and what actually exists in deliverable form. Even more revealing are the voices you don't hear. Major investment banks have gone conspicuously quiet on silver markets in recent months. The same institutions that used to issue regular research reports analyzing precious metals trends have suddenly found other topics more interesting. When was the last time you saw a major Wall Street firm publish a detailed analysis of Comex silver inventories? There's a reason for that silence. Meanwhile, our Federal Reserve officials continue insisting that commodity markets function efficiently and transparently, reflecting true supply and demand conditions through price discovery mechanisms. Those statements are becoming harder to square with reality every day that passes, with this price disconnect persisting. Either our regulators don't understand what's happening in silver vaults right now, or they understand perfectly and have decided that acknowledging the problem would be worse than ignoring it. The International Energy Agency projects that solar panel installation will need to double by 2030 to meet global climate commitments. Every single one of those panels requires silver paste for the photovoltaic cells that convert sunlight to electricity. No silver, no solar panels. No solar panels, no energy transition. It's that simple. Yet somehow our commodity exchanges continue pricing silver as if industrial demand were static and inventory constraints were temporary inconveniences rather than structural shortages. What you're witnessing isn't just a supply squeeze in a commodity market. You're watching the slow-motion collapse of trust between paper and physical markets, between what exchanges claim exists and what dealers can actually deliver, between the official price and the real cost of getting metal in your hands. That December vault raid was a warning shot, a stress test that revealed fractures in a system most Americans didn't even know existed. And if you think 47.6 million ounces was dramatic, wait until you see what happens when the industrial buyers really start panicking. Here's what changed everything, and why that December vault raid wasn't just a one-time squeeze that'll blow over. A year ago, on January 15th, 2025, the Chinese government implemented new export licensing requirements for refined silver leaving the country. You probably didn't see this story on the evening news. It didn't trend on social media. But quietly, systematically, China locked the door on 70% of the world's refined silver supply, and 12 months later, our industrial economy is finally realizing what that means. Let me explain why this matters to your daily life. China doesn't just mine silver, though they're one of the world's largest producers. More importantly, China has spent the last 2 decades building the refining infrastructure that processes raw silver ore into the pure metal that manufacturers actually need. According to data from the China Non-Ferrous Metals Industry Association, Chinese refineries now process roughly 70% of global refined silver annually. Mexican mines might pull silver out of the ground. Peruvian operations might extract it from copper deposits. But chances are that silver gets shipped to refineries in China for processing before it becomes the pure bars or industrial-grade material that goes into your phone, your car, or your solar panels. For years, this arrangement worked beautifully for Western commodity markets. When Comex vaults ran low on inventory, when delivery demands picked up, when industrial buyers needed more physical metal than domestic sources could provide, there was always a release valve. Silver would flow from Chinese refineries to Western markets, keeping our exchanges liquid and our manufacturers supplied. Comex officials knew they could count on this pipeline. It was the safety mechanism that prevented previous supply squeezes from breaking the system. Then China changed the rules. The new licensing system doesn't technically ban silver exports. That would be too obvious, too provocative, likely to trigger international trade disputes. Instead, it creates a bureaucratic maze that effectively controls the flow. Companies wanting to export refined silver from China now need special licenses that can take months to obtain. Applications require detailed disclosure of destination countries, end users, and intended purposes. Renewals aren't automatic. And perhaps most tellingly, approval rates for Western buyers have been declining steadily throughout 2025, according to trade data compiled by metals analysts. Think about the geopolitical implications for a moment. China watches the United States leading the global transition to solar energy, electric vehicles, and advanced electronics, all technologies that absolutely depend on silver. China sees our defense contractors ramping up production of missiles, radar systems, and advanced weaponry, all of which use silver extensively. And China controls the refining capacity that turns raw silver into usable metal. Do you really think they're going to keep the pipeline flowing freely to strategic competitors when tensions over Taiwan, trade policy, and technology dominance keep escalating? Pop quiz. What do you do if you're Boeing, trying to build aircraft with advanced avionics that require silver? What is your move if you're a solar panel manufacturer in Arizona trying to meet exploding demand for domestic installations? What happens when you're a defense contractor with Pentagon orders for weapon systems, and the metal you need flows through refineries in a country that our government increasingly views as a strategic rival? You stockpile, you hoard, you secure supplies for the next 12 to 24 months, and you pay whatever premium is necessary to guarantee delivery. That's exactly what started happening in the fourth quarter of 2025, and it's why the Comex vault raid in December was just the visible tip of a much larger iceberg. According to industry sources speaking to Bloomberg in late 2025, major Fortune 500 industrial companies began quietly approaching bullion dealers and refineries with unprecedented orders. We're not talking about their normal quarterly purchases. We're talking about companies that usually operated on just-in-time inventory management, suddenly wanting year-long supplies secured immediately, regardless of cost. One metals broker, speaking on condition of anonymity to the Financial Times, described receiving a call from a major aerospace manufacturer in November 2025. The company wanted to lock in 18 months of silver supply at fixed prices, willing to pay $7 premiums over Comex spot rates. They didn't even try to negotiate the premium, the broker explained. They just wanted confirmation we could deliver the physical metal on schedule. Price was secondary to certainty of supply. When corporations that built their entire business models around cost efficiency suddenly stopped caring about $7 premiums, panic is setting in. The mathematics of our silver market have become absolutely brutal, and China's export restrictions just made an already tight situation completely unsustainable. The Silver Institute's 2025 World Silver Survey documented a global deficit of 282 million ounces between supply and demand. Let that sink in. The world consumed 282 million more ounces of silver than mines produced. That's not a one-year anomaly. We've been running deficits for several consecutive years now, draining above-ground stockpiles to meet industrial demand. Here's where the numbers get really troubling. Global mine production of silver has essentially flatlined around 835 million ounces annually, according to data from the World Silver Institute. Despite higher prices, despite increased exploration, despite improved extraction technology, mines aren't producing significantly more silver than they did 5 years ago. Meanwhile, solar panel production alone now devours over 200 million ounces per year. That's up 300% from 2020 levels. Electric vehicle manufacturing uses roughly 60 million ounces annually and growing. Electronics, medical devices, water purification systems, and dozens of other industrial applications consume hundreds of millions more. Do the simple math with me. If we're producing 835 million ounces from mines, recycling perhaps another 150 million ounces from scrap and industrial waste, that gives us total supply around 985 million ounces. But total demand now exceeds 1.2 billion ounces when you add up all industrial uses, jewelry, coins, and investment demand. Where does that 200 to 300 million ounce shortfall come from every year? It comes from above ground inventories. It comes from government stockpiles being drawn down. It comes from existing holdings being liquidated. And increasingly, it comes from Comex registered vaults being drained. This isn't a problem you can solve by just raising prices a little bit. You can't simply pay miners $5 more per ounce and magically get another 200 million ounces of production. Silver doesn't work that way. Most silver comes as a byproduct of mining other metals: copper, lead, zinc, gold. You're mining copper for copper, and the silver that comes along is a bonus. Even if silver prices doubled, miners wouldn't dramatically increase copper production just to get more byproduct silver. The supply response is inelastic. meaning production doesn't rapidly increase when prices rise. Meanwhile, demand keeps accelerating in ways that have nothing to do with silver's price. The International Energy Agency projects that solar panel installations need to triple by 2030 to meet global climate commitments. Every major automaker has announced aggressive electric vehicle production targets. The 5G infrastructure build-out continues expanding globally. Defense budgets are rising as geopolitical tensions increase. None of these industrial users will stop buying silver because the price went from $71 to $90 or even $120 per ounce. Silver represents a tiny fraction of the total cost of a solar panel or an electric vehicle. Manufacturers will pay what they must to keep production lines running. Here's what should really concern you about this supply-demand imbalance. In a normal commodity market, when consumption exceeds production year after year, prices rise until they accomplish two things. They incentivize more production, and they destroy enough demand to bring the market back into balance. But silver in 2025 faces a unique situation where production can't meaningfully increase regardless of price. And industrial demand won't decrease until you reach truly catastrophic price levels that shut down entire manufacturing sectors. What happens when an unstoppable force meets an immovable object? What happens when 200 million ounces of annual deficit meets 100 million ounces of Comex registered inventory? The math isn't complicated. In previous silver squeezes, 2011, 2020, even early 2024, Comex could always count on silver flowing in from China to replenish drained vaults. Registered inventory would fall, premiums would spike, and within a few months, shipments from Chinese refineries would arrive to rebuild stocks. That safety valve no longer exists. The January 2025 licensing requirements ensure that Chinese refined silver now serves Chinese strategic interests first, Chinese industrial needs second, and Western commodity exchanges a distant third at best. Several major Western refineries have announced expansion plans to reduce dependence on Chinese capacity, but here's the problem with that solution. Building refining capacity takes years, not months. Environmental permits, construction timelines, equipment sourcing, skilled worker training. You're looking at 3 to 5 year timelines before significant new Western refining capacity comes online. Our industrial economy doesn't have 3 to 5 years to wait. Solar manufacturers need silver this quarter. Defense contractors have Pentagon delivery schedules next month. The disconnect between when we need supply and when we can create new supply creates a dangerous gap. This is why smart industrial buyers stopped trusting Comex price signals in late 2025 and started securing physical supplies directly, regardless of cost. They've done the same math you're doing right now. They've realized that the official $71 paper price exists in an increasingly fictional world disconnected from physical reality. And they've concluded that paying $85 or $90 per ounce today is far smarter than paying $120 in 6 months. Or worse, finding no available supply at any price. The hoarding behavior creates its own accelerating spiral. Each company that locks in 12 months of supply removes that silver from available market inventory. As inventory shrinks, the next company to secure supplies faces higher premiums and longer delivery times. That company then orders even larger safety stocks to avoid future shortages, removing even more silver from circulation. Multiply this dynamic across dozens of Fortune 500 manufacturers, and you create exactly the kind of panic buying that drains Comex vaults in days rather than months. Wall Street analysts keep publishing reports claiming the silver market will rebalance once prices rise enough to incentivize more production and discourage marginal demand. Those analysts are applying textbook supply-demand theory to a market that's broken free from textbook behavior. This isn't a normal commodity cycle that'll resolve with typical price adjustments. This is a structural shortage meeting export restrictions, meeting industrial panic, creating a perfect storm that mathematical models never anticipated. And every day that passes with physical premiums widening while paper prices stay suppressed, more industrial buyers lose faith in the exchange system and race to secure real metal. Now let me tell you about the clause buried in every Comex silver futures contract that most traders never think about until it's too late. It's called force majeure, and it's the emergency escape hatch that allows the exchange to change the rules when physical delivery becomes impossible. Here's the provision in plain English. If Comex determines that extraordinary circumstances prevent normal contract settlement, they can suspend physical delivery requirements and force cash settlement instead. Your contract that says you're entitled to physical silver bars? With one declaration, it becomes a contract for paper dollars at whatever price the exchange deems fair. Think about what that means for anyone holding paper silver contracts right now. You bought those contracts believing you had a legal right to demand physical metal. You watched the December vault raid drain 60% of registered inventory. You calculated that at current delivery rates, the entire remaining stock could vanish in weeks. So you decided to stand for delivery, to claim your physical silver before it's gone. Then one morning you wake up to an announcement. Comex has declared force majeure due to unprecedented delivery demands, and your contract will be cash settled at the official closing price. Sorry, no physical metal for you. Has this happened before? Absolutely. In 1980, when the Hunt brothers tried to corner the silver market, Comex changed the rules mid-game to save the shorts. They implemented Silver Rule 7, which effectively prohibited new long positions and required liquidation-only trading. The Hunts were forced to unwind their positions at devastating losses. In March 2022, the London Metal Exchange faced a nickel squeeze when prices spiked above $60,000 per ton. The exchange's solution: they canceled billions of dollars worth of trades that had already executed, rolled back prices, and imposed trading restrictions. The institutions caught on the wrong side of that squeeze were saved by regulatory intervention, while traders who'd made correct bets got their profits erased retroactively. But here's what makes the 2026 silver situation fundamentally different from those historical precedents, and why force majeure this time creates political complications that exchange officials have never faced before. The Hunt brothers were speculators trying to manipulate a market for profit. The nickel squeeze involved Chinese metals tycoons and hedge funds making leveraged bets. These were financial players that regulators felt comfortable crushing to preserve market stability. Nobody's retirement account depended on the Hunt brothers getting their silver. No critical infrastructure required hedge funds to receive nickel delivery. This time, the parties demanding physical delivery from Comex aren't speculators you can dismiss as greedy gamblers who knew the risks. They're Boeing engineers who need silver for avionics systems. They're Tesla production managers who can't build electric vehicles without it. They're Lockheed Martin procurement officers facing Pentagon contracts for weapon systems that absolutely require physical silver to manufacture. When you force settle those contracts in cash instead of metal, you're not just wiping out some investors' paper profits. You're potentially disrupting our defense industrial base, our automotive manufacturing sector, and our renewable energy build-out. Imagine the phone call from a defense contractor to their congressional representative. Senator, we have contracts to deliver missile guidance systems to the Air Force, but Comex just cash settled our silver futures instead of giving us the physical metal we need for production. Our assembly lines could stop in 6 weeks. What do you want us to tell the Pentagon? Now multiply that conversation across a dozen Fortune 500 companies with urgent industrial needs and powerful political connections. Do you think Comex officials can simply declare force majeure and move on like nothing happened? Or do you think they'll face unprecedented pressure to somehow honor physical delivery commitments to industrial buyers while hanging retail investors and smaller financial players out to dry? The mathematics of our current trajectory are brutally simple. As of early January 2026, Comex registered vaults hold approximately 95 million ounces of silver available for immediate delivery. That December vault raid pulled 47.6 million ounces in just 4 days. Even if delivery demands moderate to a more sustainable pace of 10 to 15 million ounces per week, which is still historically massive, you're looking at complete inventory depletion within 6 to 10 weeks. Industry analysts tracking these flows now estimate the critical zero point arrives somewhere between mid-March and early April 2026. What happens when registered inventory hits zero? Comex has 3 possible responses, none of them pretty. Option 1, they find a way to replenish vaults with massive silver shipments from somewhere, somehow. But where's that silver coming from? China's export restrictions block the traditional pipeline. Western refineries can't scale production fast enough. Existing holders of eligible inventory aren't converting it to registered status because they're smart enough to see the same writing on the wall you're reading right now. Option 2, silver prices spike dramatically to ration available supply and destroy enough demand to bring the market back into balance. We're talking about prices that would need to reach levels high enough to actually shut down industrial production, probably well north of $150 to $200 per ounce. Or option 3, the most likely scenario. Comex declares force majeure before inventory reaches absolute zero, probably when registered stocks fall below some critical threshold. They've determined privately, maybe 20 million ounces. They'll suspend physical delivery, force cash settlement on most contracts, and probably implement some system to prioritize industrial buyers with legitimate commercial needs over financial speculators. They'll claim they're protecting market stability and ensuring critical manufacturers can continue operations. And they'll absolutely savage anyone holding paper silver contracts who was counting on physical delivery. Here's the death spiral dynamic that makes this endgame virtually inevitable now. Every day that the gap between Comex paper prices and physical street prices remains this wide, every rational market participant faces the same calculation. If you can demand delivery of silver at $71 per ounce through a Comex contract, then immediately sell that physical metal in the retail market for $85 to $95, you've just made a risk-free profit of $14 to $24 per ounce. That's not speculation, that's arbitrage. In arbitrage, opportunities this large don't persist in functional markets because traders aggressively exploit them until they disappear. The only way this arbitrage persists is if traders doubt they'll actually receive physical delivery from Comex. But paradoxically, the longer the arbitrage exists, the more traders are incentivized to try standing for delivery to capture those profits. And each delivery request drains registered inventory further, bringing the system closer to the point where Comex must suspend deliveries, which validates the concerns that created the arbitrage in the first place. It's a self-fulfilling prophecy accelerating toward an inevitable conclusion. Think about the game theory from an industrial buyer's perspective right now. You're the procurement manager at a solar panel manufacturer. You need 20 million ounces of silver over the next year to keep your production lines running. You can buy Comex contracts at $71 and demand physical delivery, or you can pay $88 directly to bullion dealers with 8-week delivery times. The smart financial move seems obvious. Buy the cheaper Comex contracts and save $17 per ounce. But what if Comex declares force majeure next month and cash settles your contracts? Suddenly, you have paper dollars instead of physical metal, your production lines are stopping, and you're scrambling to find silver in a market where premiums have spiked even higher due to panic. So what do? You buy both. You load up on Comex contracts hoping you can take delivery before force majeure hits, while simultaneously securing physical metal from dealers as insurance even though it costs more. This dual buying approach means you're pulling silver from both paper and physical markets simultaneously, accelerating inventory depletion on both fronts. Multiply this strategy across 50 major industrial companies, and you create the perfect storm that guarantees system failure. The survivors of this crisis will be the individuals and institutions who understood one critical truth. In a contest between paper promises and physical metal, physical always wins eventually. History teaches this lesson repeatedly, but each generation seems to need to learn it again through painful experience. People holding paper claims on silver when Comex declares force majeure will receive cash settlements at prices that do not reflect physical reality. People holding actual silver bars in secure storage will own an asset that industrial buyers desperately need and cannot manufacture or substitute. I'm not telling you this to create panic. I'm telling you this to create awareness and empower you to make informed decisions while you still have options. As of early January 2026, you can still buy physical silver, though you'll pay premiums and wait for delivery. You can still take certain actions to position yourself appropriately for what's coming. The door hasn't closed yet, but it's closing, and the timeline we're looking at suggests you have somewhere between 60 and 120 days before the system breaks in ways that fundamentally reshape our precious metals markets. Here's what I want you to understand clearly. This isn't about betting against our country or rooting for financial chaos. This is about recognizing that our commodity exchange system has created a disconnect between paper prices and physical reality that cannot persist indefinitely. It's about understanding that China's export restrictions have severed the safety valve that used to prevent these situations from reaching crisis levels. It's about acknowledging that industrial demand for silver has grown far beyond what our supply infrastructure can sustainably deliver at anywhere near current prices. The people who positioned themselves correctly before previous market dislocations, those who bought gold before Nixon closed the gold window in 1971, those who recognized the housing bubble before 2008, those who understood the bond market dynamics before recent bank failures, weren't prophets or market manipulators. They were simply paying attention to mathematical realities that others chose to ignore because confronting them was uncomfortable. Right now, in early 2026, you have access to the same data, the same inventory numbers, the same delivery reports that I'm sharing with you. The question is what you choose to do with this information. Wall Street will tell you that markets always self-correct, that prices will adjust to balance supply and demand, that concerns about Comex delivery failures are overblown fear-mongering. Those are comfortable narratives that maintain faith in our financial systems. And in normal times, they're often correct, but we're not in normal times. We're in a situation where physical and paper markets have diverged dramatically, where the largest refining capacity is controlled by a strategic competitor restricting exports, where industrial demand is accelerating beyond any reasonable supply response, and where exchange inventories are draining at rates that guarantee mathematical impossibility within months. You still have time to act. You still have the ability to secure physical silver, albeit at premiums above paper prices and with delivery delays. You still have the opportunity to understand these dynamics and make decisions based on physical reality rather than paper promises. What you choose to do with that opportunity is entirely up to you. But understand clearly that the clock is ticking. And when Comex finally acknowledges what the numbers have been screaming for months, The door to physical acquisition at any reasonable price will slam shut permanently for most retail buyers. This isn't the end of silver markets. This is the beginning of their transformation into something more honest, a market where paper claims and physical metal are priced according to their actual scarcity and utility rather than synthetic supply created through financial engineering. Those who navigate this transition successfully will be the ones who recognized the signs early, acted decisively while options still existed, and understood that in the final analysis, you can't manufacture silver by printing contracts. You can only dig it out of the ground, refine it into usable form, and deliver it to those who need it. Everything else is just paper promises, subject to force majeure clauses, when reality finally demands its reckoning. If you made it this far, you're exactly the kind of person who understands that financial awareness is not about fear. It's about preparation. Hit that subscribe button and drop a like if this kind of real market analysis matters to you, because the stories Wall Street doesn't want told are the ones worth sharing. Stay sharp out there.